Hi everyone and welcome to today's video. I'm Ragini Mukundan, a Microsoft Dynamics 365 ERP functional consultant at Cetas. This is part 6 of the series Understanding COGS Calculation in Microsoft Dynamics 365 Business Central. So far, we have only talked about posting actual inventory and actual COGS values. But in real life, companies receive goods much earlier than they receive invoices. Similarly, goods are shipped earlier than sales invoices are posted. However, in Business Central, the GL entries are created only after the purchases or sales are invoiced. Because of this gap, Business Central has a feature called expected cost posting. This helps the system temporarily estimate inventory and cost values even before the actual invoice arrives. This is what we'll be talking about today. We will be covering the following points. What is expected cost posting in Business Central? Why companies use it and where to enable it? Understanding interim accounts and where to find them. Entries created during purchase receipt and sales shipment and how the entries change when the actual invoice is posted. And finally, about expected cost posting and COGS. What exactly is expected cost posting? Expected cost posting means post temporary values to the general ledger even before the real invoice arrives. Let's take the case of purchases. In real business, you may receive goods today but get the supplier invoice 5 to 10 days later. Without expected cost posting, the GL shows nothing until the invoice arrives. With expected cost posting, the GL temporarily reflects the increase in inventory, liability estimate, and the estimated cost of the shipped items. This helps for internal tracking. When the actual invoice is posted later, the temporary entry is automatically reversed and the real entries are posted with the actual cost. So, Business Central always starts with temporary numbers and replaces them with the real ones later. Why do companies use expected cost posting? As I mentioned earlier, companies use it because physical movement happens before invoicing. Almost every company deals with timing differences. Goods come today and the invoice comes after 5 to 30 days. If Business Central waits for invoices to reflect the inventory value and COGS, then inventory reports will look understated. Managers won't know the real impact until later. Month end will be painful and full of sudden adjustments. Companies want earlier visibility of inventory value. They want accruals to reflect incoming stock before the invoice arrives. They want answers to questions like what is our liability? Do we owe the vendor something? Or in the case of sales, what is our receivable? Does the customer owe us for the shipped goods? So, Business Central temporarily shows the financial impact using estimates until the actual invoice arrives. Expected cost posting gives you this picture without touching the profit and loss. Let's talk about the interim accounts. For expected cost posting, we use three main interim accounts: the inventory accrual account interim, COGS account interim, and the inventory account interim. Out of these accounts, the first two accounts can be configured in the general posting setup, and the interim inventory account can be specified in the inventory posting setup. Let's have a look at these accounts in the Business Central environment. Here we can see the inventory accrual account interim and the COGS account interim. And here we have the inventory account interim. The inventory accrual account interim is a purchase interim account. The COGS account interim is a sales interim account. Inventory account interim is a temporary general ledger account used to record the expected value of inventory for both purchases and sales until the related invoices are posted. Let's talk about expected cost posting and purchases. Normally, without expected cost posting, when we post a purchase receipt, no GL entry is created. Only item ledger entries and value entries are created. When a purchase invoice is posted, the entries purchases debit to payables and inventory to direct cost applied are created. With expected cost posting switched on, when the goods are received but not invoiced, one interim entry is created. That is, inventory account interim debit to inventory accrual account interim. This is temporary. It is just Business Central saying goods have arrived, so it must appear in the inventory value. When the vendor invoice arrives, Business Central does two things. First, it will reverse the temporary entries. Second, it posts new entries with actual cost. So, a total of 3 entries occur. Accordingly, our first entry will be Inventory Accrual Account Interim Debit to Inventory Account Interim. BC removes the temporary posting and this brings the interim balances back to 0. Next, BC posts the actual purchase expense entry, which is Purchases Account Debit to Payables. Then, BC posts the actual cost adjustment entry, that is, Inventory Account Debit to Direct Cost Applied. The interim values are replaced with accurate values. So yes, we have one reversal entry plus 2 actual entries coming to a total of 3 entries. Something similar happens with sales as well. Without expected cost posting, the sales shipment does not record any GL entries. It records only the item ledger entries and the value entries. The sales invoice records the usual 2 entries, which is receivables debit to sales and COGS debit to inventory. With expected cost posting, when the goods are shipped but there is no sales invoice yet, BC posts a temporary cost of shipment, that is, COGS account interim debit to inventory account interim. This tells BC we shipped the item and we expect this much cost outflow even though the sales invoice is not yet posted. When the sales invoice is posted, again 3 entries are created. The first is the reversal entry, that is inventory account interim debit to COGS account interim. The second is the real sales entry, which is receivables account debit to sales. The third is the real sales COGS entry, where the COGS account is debited and the inventory account is credited. Thus again, we have one reversal entry, one sales entry and one real COGS entry amounting to a total of 3 entries. Now comes the real deal. COGS impact of expected cost posting. Expected cost posting is designed to show the temporary impact of goods that have been received or shipped even before the actual invoice is posted. Think of it like this. When you receive the goods, PC temporarily posts inventory account interim debit, which is an asset, to inventory accrual account interim, which is a liability. Similarly, when you ship the goods, BC temporarily posts COGS account interim debit, which is an asset, to inventory account interim, which is an asset. So, in the case of purchases, there is an increase in assets and liability. Whereas in the case of purchases, there is an increase in an asset and a decrease in another asset. These are not real expenses or revenues. They are only temporary balance sheet adjustments. Why? Because in accounting, if there is no invoice, there is no real cost, no expense, no revenue impact, and no COGS either. So, BC only shows the temporary financial position. The goods have arrived, so we increase the inventory temporarily. The goods are shipped, so reduce the inventory temporarily. And there is a temporary payable or receivable. But profit must not change because nothing is confirmed yet. So, expected cost posting shows what you owe temporarily or what is owed to you temporarily. What goods you temporarily hold and what goods you temporarily shipped. What it does not show is COGS, expenses, revenue, profit, and loss, because all these belong to the profit and loss statement and accounting principles require actual invoices before recognizing them. In brief, expected cost posting does not affect COGS at all. It only updates temporary balance sheet accounts to show that goods have been received or shipped. To wrap it up, expected cost posting is simply a temporary reflection of the inventory value in the GL before the actual invoices arrive. It uses interim accounts to simulate inventory and cost movements, but these entries never affect the profit and loss. When the actual invoice is posted, all interim entries are reversed and the real purchase, inventory and COGS entries are posted. COGS is calculated only from the real invoice. Expected costs have absolutely no role in COGS calculation. This feature helps with internal cost accuracy and accruals, but does not influence profitability in any way. That brings us to the end of today's video. If you have any questions or would like us to cover specific scenarios, feel free to share them in the comments. Don't forget to subscribe to our channel for more practical Dynamics 365 insights and stay tuned for the next video in this series. Thank you for watching.